Well, what you need to know about the elements of investment risk. Today, we're going to take a look. Stay tuned for Prudent Money. Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. You know I do appreciate it. Well, if you got a question for me, please go to the website at www.prudentmoney.com. There at the site, you'll find a lot of resources, and you can just click around and see what is all available there. Plus, if you got a question, you can go to the top of the page, says Ask Bob, send it in, I'll get you taken care of. That's a very easy way to get information, and love to hear what's going on with you. So just go to the website, send it in, we'll get you taken care of. That's all at prudentmoney.com. Well, let's first start off and talk a little bit about what's happening with the stock market. You know, I find it interesting, puzzling, probably more than interesting, but very interesting in regards to what the market reacts to. You've had all kinds of geopolitical risk, and the market would just continue to go up. Then today, a CPI, which is an inflation reading, and it's supposed to be the indicator that tells exactly what's happening with inflation. Releases some figures. I mean, if you eat out, if you go to the grocery store, if you drive a car or have any dealings with gasoline, you might have somewhat of an inkling that we've got a problem here called inflation. I think everybody's aware of that. So, big shocker that this indicator is going to show that we've had one of the highest readings in 3 years. In fact, I look at the inflation indicators like CPI and think, and my first reaction is, well, shouldn't they be much higher than they are? But be that as they may, maybe it's a reminder that, hey, this is a real problem. Things aren't working out in the straight, and this thing is not looking good. Whatever it is, the market did react negatively to what's going on with inflation. However, I may be not giving the market enough credit, and the markets may be looking at the 10-year interest rate or yield. We talked about this. It comes from the 10-year government bond. And to me, as long as that yield or interest rate continues to go up, we've got a whole problem in this economy that we haven't been talking about. We used to talk about it all the time because it was really the only thing to focus on that was kind of spiraling out of control, because it was either kind of stuck in one place going back and forth, or it had taken off. And that's what you're seeing now, is you're seeing it taken off. And it, of course, is reacting to the CPI numbers and what's going on with the price of oil. But, keep in mind that as that number goes up, then you're also seeing mortgage rates go up. And mortgage rates go up, real estate sales are not what they used to be, and they're not getting, they're stuck and not getting some movement. So it could be that the market is watching what's going on in the bond market, and I would suggest that is still a real problem. And as we see that number continue to go up, it makes me wonder how high will it go. And it's also about the 30-year bond and interest and yield is about to break 5%. That's a big number. So we'll see how it pans out. But that's always once you think the market will react to some things, whereas you think the market will not react. It is so hard to call. But this is something that I thought they would not react to, because everybody knows that the inflation is what it is. So let's talk a little bit about investment risk. I mean, we cover this a lot on the program. I've got a very simple thesis that if you can take care of investment risk, if you have a decent strategy, any strategy at all that you follow in a disciplined manner, you can clear the way for future growth. And so from a stewardship standpoint, it's to me very, very important not to rely on what social media, TikTok, finance, or whatever tells you and makes it sound as if it's all easy. It's not all easy. It is easy, though, I think, to study it and become knowledgeable of how these things work. And so we're talking about the elements of an investment plan. You know, most of you are going to have, of course, 401k plans and maybe IRAs that are with financial advisors. So let's talk a little bit about that because I hear a lot here lately anyway that man, my 401k plan is doing so great. I got great funds in it. And you may have great funds in it, but you got to remember that at this point in time, it's not about the investments that automatically go up when the market goes up, because most 90-something percentile, I would think, of, if you really took a hard look at it, you get the point, of mutual funds that are stock-based mutual funds go up when the market goes up. And so, that's kind of given with the 401k. I mean, that's kind of the advantage that goes along with, stay long-term, don't change anything, which at some points in the market cycle, I think that makes sense. Other points, like the one feels like we're getting close to, is one that I don't necessarily agree with. But, don't fall asleep at the wheel, though. With my 401k has been, you should see what my 401k returned. I would shape that a little bit more to, you should see what the market has returned. It's been going up. If you're investing in stocks, you should be benefiting from that. Now, does the market always go up? Pop culture finance will tell you it does, and that's why you shouldn't worry about it. I had someone call me the other day, and they wanted me to look over their 401k plan, and her reaction to after asking the question is, after asking me to look it over, was that sure didn't want to change anything because she's got these great funds. And I said, you've got to remember that most mutual funds in a 401k plan will go up with the market, but they also go down with the market. So where is the risk, the real risk? Is it the mutual funds themselves, or is it the concept of what is pushing the stock market up? And I would suggest today, if you're looking at primarily your funds that are in your 401k plan or in your IRA or wherever they might be, if you're looking at them and just feeling really confident about just those funds, I would think twice about that, because it's the market that brought them up and the market that can bring them down. And for most plain Jane stock funds, they're going to do that. They're not built for risk. They're built for the long term. They're built for a market that has normal ups and downs, nothing catastrophic, not a bear market. In fact, what's interesting is that pop culture finance, if you look at any CNBC, any of these channels, they talk about volatility. Volatility is the problem that we've got today. That's what as the market has lost 25, 30, 35, 40%. It's, volatility is a little bit easier concept to grab a hold of. It has a lot of different people assign a lot of different meanings to it. One would be that it kind of that short-term feel of volatility that doesn't go on forever. It'll be over with and the market will go back up or whatever it might be. But it's a little bit easier of a definition to cope with and to understand and to feel okay This is happening to everybody, and it'll turn around at some point. So they definitely don't call it a bear market. A bear market has got very negative connotations to it. A bear market lasts for a long time. It can add up into really deep losses, the kinds that you certainly don't want if you're anywhere near retirement. And of course, that's a whole another subject. But what pop culture finance is to do is to make sure that you stay invested, make sure that you don't make any changes, make sure that you're not trying to time the market. And nothing that we talk about on this program is about timing the market. Because I agree with pop culture finance, it doesn't work. It's luck if you get it right. And luck, if you get it right, emboldens you to be that lucky individual year after year after year after year. And if luck strikes once, it rarely strikes twice without giving it a number of years for that to happen. So, luck doesn't make a genius. Luck makes you lucky. So we look towards the mutual fund managers themselves and our advisors. Now, there are some interesting stats that I wanted to visit with you about to bring a little bit different of a light on this subject, because we often don't think of it in these terms, but we're talking about generations here. We're talking about when the tech bust occurred, that was 26 years, 27 years ago. 911 was 25 years ago. Long time, periods of time, generations of time in some, I guess you could call it that. We'll talk about this in a second. I'm up against a break. This is Bob Brooks. You're listening to the Prudent Money Radio Show. Stick around. We'll be right back. Hello, this is Bob Brooks. Proverbs 22:3 and Proverbs 27:12 are the exact same verse word for word. I call them the stewardship verses of risk. A prudent person foresees danger and takes precautions. The simpleton goes blindly on and suffers the consequences. On the Prudent Money Radio Show, we teach about risk, how to identify it, how to figure it out, and what to do about it. We believe that to be a prudent steward, you have to be a good risk manager. Listen to the Prudent Money Radio Show on Bible School Radio 91.3. Prudent Money, home of the modern-day steward movement.
Dynamic, practical, life-changing.
There's no point in going to church and not letting the Christ who gave birth to the church on the day of Pentecost change your life.
Join us each day as Pastor Paul Shepherd applies the timeless truth of Scripture to everyday life. It's Destined for Victory on this great station.
Weekday afternoons at 3:30 here on Bible School Radio, KDKR.
This is Rob Randall, your host and teacher of the Invisible War radio program. The Invisible War is the study of God's Word on how to walk in Christ's victory in the spiritual battles we face against the powers of darkness. Join me every Sunday morning at 9 right here on KDKR and KYJC in Commerce, your station for life.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. You know I do appreciate it. Listen, if you got a question for me, I want to invite you to go to the website at www.prudentmoney.com. There is a link at the top of the page that says Ask Bob. Just click through, and we will answer whatever questions you got. If we don't know the answer or feel somebody else is better to answer that for you, we'll send you a resource and you can go check it out someplace else. But we want to make sure that you get information. My sole goal with the information we talk about is to bring you up the curve on the other side of the story, so that you can have both sides, compare them, learn about them, look at the pros and cons of both, and feel and determine how you believe about risk, what you believe about how money works. And so you own your own belief system and you can understand it. And you can't do any of that without prayer along with that process. And when you surrender to stewardship, You're asking God to be a part of the process, and that is where you are in God's financial will for your life. And I believe that God has a financial will for us, and that's a big long subject we need to talk about at some point in the very near future. Today, we're talking about risks that you may not consider, and this is one that I think is going to be a real problem because I went through the tech bubble in 2000 to 2002. I started as an advisor in 1992, and I also, of course, went through the great financial crisis. In fact, what was really interesting about that for me was being on the radio, because we were on the air at that point and really covering everything that was happening. And of course, that was my second bear market, and the experience that you get in dealing with the bear market. And I will be the first to say I've got a lot to learn. But having gone through that experience, it has taught me a lot as well. And a lot of which I share with you. So have you even considered that most mutual fund managers, the individuals who've got the certifications, the designations, all that, and who are managing the mutual fund that you are invested in, have not been in a bear market. Many analysts estimate that only about 15 to 30% of current active mutual fund managers have direct portfolio management experience from the early 2000s tech crash. That means roughly 70% to 85% of today's managers likely started after that period. Now, what's so interesting is that, we had two bad bear markets on top of each other. When I say bear market, I mean a market that's going down, prolonged over a various period of time. It just depends on what the state of that's turned it into a bear market, how all that's going. But you go from one bear market 5 years in between to the financial crisis, and that was a gut wrencher. A study examining bubble crash experience found only 23% of sampled managers had firsthand experience managing through the 2007 to 2008 crisis just a decade later, illustrating how quickly crisis-era experience disappears from the industry. Other research on the tech bubble found younger, less experienced managers tended to increase tech exposure more aggressively during the late 1990s bubble compared with older managers. And it's just, it's at that point in your career, it's how your perspective on risk has been shaped and formed. And putting more on the investments that made you so much money, and it's almost like it really is, unless you've got a good thesis behind it for doing so, it's just like playing blackjack in a casino. When the markets are as deep into a bear market as we've seen, especially the 2007-2008 financial crisis. If I had to compare the two, I would say that the tech bubble, the internet tech bust of 1999 or 2000 to 2002 was probably the most interesting bear market and really change in the system that I've been through. However, the financial crisis was just unbelievable, and there's volumes and volumes of books of mistakes and things that could have been done differently. One of the things that happened during that time period, or the question that always came out was, are we bailing companies out to bail them out, or we've gone too far? And I think the answer to that is the government played an extremely important role in reeling this financial crisis back in. And that was they took over. They did bailouts, if you can remember. It's really the first time we ever heard of it, what a bailout was. But I think, looking back on it, it was necessary to do that. The problem is, like they always do, they took it too far. So all that to say, to circle back around to experience, you got to know that most, the number of advisors is roughly about the same number of mutual fund managers, and it's a huge experience to actually go through these bear markets. It's something that you take and you benefit from, and your clients benefit from. So you got to look at that, and I think a long talk with your advisor this question warrants a long talk with your advisor, because you want to make sure that everybody's in line with one another, and you just have to pray about it and pray about making the right decisions and what you're going to do going forward. Because I do believe, I can't pinpoint the time, nor am I going to try to be a forecaster on the radio. I do think we're ending that cycle, and it looks a lot like what 1999, 2000 looked like. So we'll see. Been wrong before. Probably will be wrong at some point in the future. It's just that's all trial and error. But this has way too many characteristics of what happened in 2000 and dare I say 1929, when the Dow Jones really, really lost. Went to a horrendous, the biggest bear market on record. So, having all that to say, many veteran advisors say the dot-com, which is a tech bust, collapse permanently changed how they think about concentration risk, speculative manias, valuation discipline, and client behavior during bubbles. And ladies and gentlemen, we are in a bubble, and I would invite somebody to prove that wrong. I really do feel very strongly we are in a out of control bubble. The statistics are just over and over and over and over come out and support that. So just know that is an element of risk that is there. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. I do appreciate it. We're talking about experience with bear markets from the mutual fund manager standpoint, and from your advisor standpoint, and really what they believe about how you navigate through this topic thing. What a lot of people will tell you that are in the business, in the industry, will say, things have changed. Markets are different this time. Ooh, boy, that's always a dangerous comment to say it's different this time. I'll tell you where it's not different, and some things will, if we end up going through this type of a cycle, some things will look a lot different than ones in the past. But on the majority, they'll both look. I think they'll all look the same. The thing that you got to remember is that all of this with the market is driven by human emotion. That's the problem. They're driven by human emotion, and that's why if the first study that was done by Crown Financial Ministries, Chuck Bentley, who's on the program about once a month and the CEO of that unbelievable ministry, did a study on the Bible and found that money is talked about, referenced about, written about more than any other subject in the Bible, which I think speaks volumes to stewardship. It speaks volumes to how we handle our relationship with money and our knowledge about how money works. But the one thing that does not change is human emotion, greed, those very, very powerful emotions that take over our common sense. And if you go back, I think one of the best books that's available about how to deal with money is the Bible. I mean, if you go back and especially in Proverbs and you really dial into what the Proverbs says about risk, about investing, about diversification, it's written for any time period. That's why it looks so much like biblical times in a lot of the things that are discussed and the way and how they're discussed and the topics. So just keep that in mind. It's something that we don't often talk about, but I think is important. And it is definitely an element of risk that remains in the market. And I think we're in that real interesting time period in the cycle. And will the market collapse or will it continue to go up? Who knows? But just make sure that you're ready either way. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. If you got a question for me, please go to the website, www.prudentmoney.com, and send it in because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.